We're plunging into a true classic. It's a book the legendary investor Paul Tudor Jones actually calls a textbook for speculation. Edwin Lefèvre's Reminiscences of a Stock Operator.
A must read, really.
Absolutely. And this isn't just, a historical novel. It feels like a direct line into the mind of Jesse Livermore, one of the greatest, maybe most enigmatic traders of the early 20th century.
Sure.
We've got a real treasure trove of insights here. It's a deep dive into his strategies, his triumphs, and, crucially, his mistakes, too. Big ones.
Devastating mistakes sometimes. And what's truly remarkable about this book, told through Livermore's fictionalized character, Larry Livingston, is how it captures these timeless truths about human psychology in the markets.
Right.
It reveals that while, trading platforms change, technology moves on, the fundamental drivers, fear, greed, hope, apathy, they're constant.
They just don't change.
Exactly. So our mission today is basically to extract those enduring lessons for you, give you a powerful lens maybe to view today's markets through.
Absolutely. And you'll trace his path, starting from these obscure places called bucket shops, right up to the high-stakes world of Wall Street corners.
Quite a journey.
We'll discover how this farm boy became a market legend, often losing millions only to claw it all back again. And what that teaches us about, self-discipline, observation, tough lessons.
The toughest, maybe.
So how did this young guy, this math whiz, fueled by $5 and just this incredible curiosity, how did he start translating that raw talent into actual market success?
Well, it started, like you said, not on Wall Street, but on a rocky farm up in Massachusetts. Livermore, his mind just naturally went towards numbers.
Yeah.
He managed to escape farm labor at 14. And what I find particularly compelling is his method. It was almost intuitive, self-taught.
How so?
At just 14, working as a board boy, literally writing stock prices on a board in a Boston brokerage, he started noticing that stock prices were apt to show certain habits.
Just patterns.
Exactly. No algorithms, no deep fundamental analysis back then. Not for him, anyway. He mentally recorded hundreds of observations, clocking stocks, anticipating movements based purely on past performance. He was essentially reading the tape before he even knew the term.
Just seeing the flow.
Yeah, seeing the patterns in the numbers.
And what an environment to learn in. This wasn't like, the NYSE today. He learned his initial chops in these notorious bucket shops.
Ah, the bucket shops.
For anyone who doesn't know, maybe explain those a bit. They sound kind of sketchy.
Oh, they were more than sketchy. They were storefronts, looked like brokerages, but they weren't really executing trades on an exchange. They took bets against their customers.
So if the customer lost?
The bucket shop won. Directly. Their whole business model was based on customer failure. An incredibly predatory setup.
Wow. But common back then.
Ubiquitous, especially outside the main financial centers. They leveraged the new low-cost stock tickers and boomed, particularly in agricultural communities where people were looking for, quick returns.
Any idea of the scale?
Get this. The New York Times estimated back in 1889 that patrons wagered the equivalent of 1 million shares daily in bucket shops. Compare that to just 140,000 on the actual New York Stock Exchange.
1 million shares a day, so it was huge.
Massive. It was almost seen as this sort of democratized exchange, giving the common person a shot at speculation, but it was rife with exploitation.
So he's observing, he's clocking stocks. How did he take that first practical step? Test his system.
His very first trade, it was small. He pooled his money with a friend to buy Burlington stock, based entirely on his dope book. That's what he called his mental notes on stock habits.
Did it work?
They made a profit of $3.12.
$3.12. Doesn't sound like much.
Seems tiny, right? But for Livermore, it was huge. It was the first real proof. Validation that his observations, his theories, actually had predictive power in the real world.
That must have been electrifying for a teenager.
You have to imagine so. It set him on his path.
Okay, so that's the start. But he didn't just win occasionally, did he? He got so good, the bucket shops actually started banning him. How did he manage that? How did he exploit their system?
He quickly figured out their weaknesses. For instance, he'd make tiny trades at a legitimate broker just to get a specific price printed on the ticker tape.
Why?
So he could then use that official printed price to settle his bets advantageously at the bucket shop. He even manipulated inactive stocks, sometimes with small trades, to force a price change.
That's pretty cunning.
It sounds like it, but it was also survival in that environment. He had to be incredibly persistent, sometimes even threatening them just to collect his winnings because these shops didn't want to pay out.
Right.
It really shows his early resolve, but also just how adversarial and, Wild West that whole scene was.
Okay, that brings us to a really pivotal moment. Livermore eventually outgrows or gets kicked out of the bucket shops.
Yeah.
He has to move to the legitimate stock exchange houses in New York.
The big leagues.
You'd think his tape reading system would just work perfectly there, right? But the book says he found the game was altogether different. What happened? Why was it such a shock?
It was a brutal transition for him. I mean, he'd already made and lost fortunes by the time he was 25.
Wow, by 25.
Yeah. He realized the mechanics were different, sure, but more importantly, his mindset had to change. He famously said, "What beat me was not having brains enough to stick to my own game."
Meaning?
That is, to play the market only when I was satisfied that precedents favored my play. He learned about what he called the Wall Street fool, who thinks he must trade all the time.
The need for constant action.
Exactly. He blamed his early New York losses on this craving for excitement and what he called expensive enemies within himself. It wasn't about the data, it was about his own discipline, or lack thereof at first.
That's fascinating because Livermore's emphasis on waiting, on patience, it really clashes with the always on, always be trading vibe you see so much today, right?
Oh, absolutely. It's a direct challenge.
So how do we, as modern investors maybe, reconcile that constant pressure we feel with his big lesson about strategic inaction?
Well, that's the core challenge, isn't it? Livermore learned the hard way the incredible importance of patience and conviction. He shifted gears completely from the quick, high-leverage bets of the bucket shops.
How so?
He started waiting weeks, sometimes even months, for a stock he liked to move up, say, 30 points before he'd even buy it.
Wait, after it moved up 30 points, not before?
Right, because, as he put it, he had to be right. It showed the trend was truly established. This was a huge evolution in his thinking. He found real success came when he was backing my own opinions, not just chasing every little wiggle on the tape.
So letting the market prove him right first.
Letting his conviction mature, yeah. Not forcing trades out of boredom or feeling like you have to be doing something.
And speaking of conviction, he tells this really painful story about outside influence. A friend, Ed Harding, convinces him to short Union Pacific.
Oh, that one hurt.
Only for the company to declare a massive 10% dividend the very next day. A huge mistake, cost him a fortune, all because he listened to someone else instead of his own tape reading.
Yeah, he admitted, whatever it was that made me decide to follow his advice, I cannot tell you, but follow it, I did. It sounds like such a common trap, doesn't it? Even for the greats.
Totally. So how do you balance that? Getting advice versus sticking to your guns?
That's the eternal tightrope walk, isn't it? The tension between seeking good counsel and having absolute faith in your own hard-won judgment. Livermore's regret there wasn't just about the bad advice. It was the deeper cost of abdicating his own intuition, his own method. He eventually stated flatly, without faith in his own judgment, no man can go very far in this game.
A lesson learned through, as you say, very expensive tuition.
The most expensive kind. It's a constant reminder to filter advice, no matter how trusted the source, through your own analysis, especially when the stakes get high.
So Livermore's career wasn't just about these internal battles. It was also shaped by these huge market events, seismic shifts. And often, he managed to be on the right side, like the San Francisco earthquake in 1906. How did that play out?
That was uncanny. He had a hunch, as he called it, to sell Union Pacific short just before the news hit.
A hunch. Or was it more?
Well, he made $250,000 in just a few days before the market really plunged. He described it as feeling like Providence working. But you have to think, it wasn't just luck. It was his incredibly finely tuned sense of underlying conditions, maybe sensing instability and reacting with lightning speed.
And that keen sense, that ability to read the market's mood, really shone during the wider panic of 1907 too, right?
Absolutely. That was a defining moment. While so many were ruined, Livermore, well, he initially lost a bit covering shorts too early, but then he went short again massively.
They caught the big move down.
He did. And then, crucially, as J.P. Morgan and the big financiers stepped in to stabilize things, he saw the turn coming and flipped, went long.
Wow, so he played both sides.
He made about $1.5 million during that chaos. Described it as feeling like king for a moment. It just highlights his incredible ability to adapt, to shift gears, and capitalize on extreme market fear, both the panic selling and the relief rally.
He wasn't just in stocks, though. Commodities were a big playground for him, too.
Yeah.
I'm thinking of that legendary bear bait play in corn back in 1907. What was that? How did that work?
The bear bait. That was brilliant. Really showed his understanding of market psychology, how these things connect. He had this large losing short position in corn.
Okay.
And another big operator, someone he calls Stratton, was trying to corner him, squeeze him out.
Right. So what did Livermore do?
Instead of fighting Stratton directly in corn, he strategically started selling oats, a related commodity. He dumped oats on the market.
Why oats?
Because he knew traders would see oats breaking down and get spooked about corn too, triggering a sell-off there. He called it pretty cheap bear bait. The loss on the oats was minimal, like $3,000. But that small move allowed him to cover his huge corn short profitably and escape Stratton's corner. It wasn't about fundamentals. It was pure anticipation of human reaction, how fear spreads.
That is some serious market chess right there.
Definitely.
And he had another huge commodity win with the July cotton corner. Everyone else was bearish, selling cotton, but he saw something different. What was his angle?
His insight was simple but powerful. The shorts were running out of time. They didn't have much time left to buy back their positions before the July contract expired.
The deadline pressure.
Exactly. So while everyone else was selling, he started buying. Systematically. First 100,000 bales, then another 40,000. He effectively created a corner.
Just kept buying.
He understood what he called the line of least resistance. He wasn't just guessing. He saw the market set up, waited for the right moment, then acted decisively when he knew the market could absorb his buying, and later, his selling.
So how did he get out? That's always the tricky part with a corner.
He noted, you cannot always sell out when you wish or when you think it wise. You have to get out when you can. And he did. One morning, the market opened wild, and he unloaded all 140,000 bales in just 10 minutes.
10 minutes. At the top.
Right near the top prices. A massive coup.
But even Livermore, the master, the lone hand as he liked to think of himself, he still made massive mistakes.
Yeah.
Especially when he let others, or maybe his own ego, get in the way.
Oh, yeah.
The Percy Thomas cotton trade seems like the ultimate example. He lost almost everything he'd made before. What went wrong there? Why does he call it his super sucker play?
That was just catastrophic. He completely abandoned his own judgment. He kept buying cotton, massive amounts, based purely on Percy Thomas's insistent advice.
Why? Just because Thomas said so?
Not just because Thomas said so, but because he got sucked into trying to support the price. He was buying to keep the price from going down. He wasn't trading the market, he was fighting it based on someone else's opinion.
Violating his own hard-learned rules.
Every single one. He admitted it himself. For me, of all men, to violate all the laws that experience had taught me to observe in order to prosper was more than asinine. It just perfectly highlights that constant internal battle against our own human weaknesses. Impatience, hope, ego, wanting someone else to be right for us. The struggle to remain, as he put it, equally unaffected by men and misfortunes.
It's pretty sobering, isn't it, that even someone with his experience could fall into that trap so spectacularly.
It's deeply sobering. Shows nobody's immune.
So, reflecting on his whole journey, the incredible highs, the crushing lows, what are the big, enduring laws of speculation he uncovered? The principles that still feel so relevant today?
Well, he learned, as he said, the game taught me the game, and it didn't spare the rod while teaching. Experience was everything. But distilled down, continuous study of general conditions, the big picture, immense patience, his famous advice to sit tight, and that unwavering commitment to your own judgment. He declared, I never argue with the tape. Getting angry at the market, he said, it's like getting mad at your lungs because you have pneumonia. Pointless.
Accept reality.
Accept reality and manage yourself. He advocated selling down to the sleeping point.
Meaning reducing your position size.
Exactly. Reducing it until you can actually sleep at night, until the anxiety doesn't cloud your judgment. Simple, but profound self-management. He also believed, fundamentally, nobody can catch all the fluctuations. In a bull market, your game is to buy and hold until you believe that the bull market is near its end.
That's powerful advice. Yet today, maybe more than ever, we're bombarded with tips. Social media, news, everyone's got a hot stock tip. What was Livermore's stance on tips?
He absolutely despised them, fiercely against them. He called tip takers like drunkards, blinded by hope, unwilling to do their own thinking.
Like looking for a shortcut.
Precisely. He tells a great story about John W. Bates, another big operator. Gates supposedly made a fortune by always doing the exact opposite of tips given to him by a famous insider named Westlake.
Really? Just faded the insider.
Yeah, Gates apparently told Westlake, you told me to sell Redding, so I bought it. I've always made money coppering your tips, Westlake. It just speaks volumes about that perennial human desire for easy answers, for someone else to have the secret instead of doing the hard work yourself.
It makes me wonder, though, given some of the market manipulations he himself was involved in, especially early on, and just the rough and tumble nature of markets back then,
Right.
how do his methods and lessons fit with today's much more regulated environment? Is it still relevant when the law of the jungle, as he called it, has been tamed somewhat?
That's a really important question. He definitely contrasted the old-style manipulations, think Commodore Vanderbilt cornering Harlem Railroad, or Jay Gould schemes with his own approach later on.
Yeah.
And yes, the regulations that came in during the 30s and 40s fundamentally changed the game, ending that pure law of the jungle.
Boy.
However, and this is the absolute key point, the underlying human psychology that allowed those manipulations, that drives booms and busts, that hasn't changed one bit.
Still fear and greed.
Still fear and greed, hope and despair. Even when Livermore admitted to taking stock options, like in Imperial Steel, as a fee for pushing the price up, he claimed he only did it because he genuinely believed in the company's underlying value. He wasn't just trying to fleece the public, or so he said.
Interesting distinction.
The tools change, the rules change, but the emotional engine driving the market, as Paul Tudor Jones points out in the foreword, that remains constant. So there is nothing new under the sun in the art of speculation. Livermore's insights tap into that unchanging core.
That connects perfectly to that insight from Thomas F. Woodlock you mentioned earlier. The principles of successful stock speculation are based on the supposition that people will continue in the future to make the mistakes that they have made in the past.
Exactly. And Livermore deeply believes that. He felt that, especially in bull markets, outright manipulation often wasn't even necessary.
Why not?
Because the public, driven by what he called cupidity greed, and spurred by a pervasive prosperity, will always chase easy money. They'll basically manipulate themselves through enthusiasm and FOMO.
Fear of missing out.
Yeah. And as he dryly observed, people who look for easy money invariably pay for the privilege of proving conclusively that it cannot be found. His lessons resonate because they're about us, about human nature, which is far more constant than any set of market rules.
So, okay, let's bring it all together. What does this all mean for you, our listener, trying to navigate the complexities of today's markets? The Livermore story, these incredible highs, devastating lows. It seems to boil down to a few really critical takeaways.
I think so. First and foremost, the absolute power of independent thought and careful observation. Learn to think for yourself. The market, he said, is an efficient educational agency, but only if you learn to capitalize your mistakes, not just feel bad about them.
Learn from them, don't just suffer them.
Right. He was blunt. The punishment for being wrong is to lose money. The reward for being right is to make money. Extract the lesson from the loss. That's the capitalization.
And maybe the toughest lesson of all, the one he seemed to struggle with constantly. Guard against your own human weaknesses.
Absolutely crucial. Don't let impatience or excitement or fear of missing out or even well-meaning advice from friends override your own hard-won judgment and analysis. Play your own lone hand, as he put it. Trust your work on the underlying conditions.
Easier said than done sometimes.
Always easier said than done. But for anyone really looking to understand markets, not just trade tickers, this deep dive into Livermore's world shows that true success isn't really about avoiding losses altogether. That's impossible.
Right.
It's about consistently sticking to sound principles, learning relentlessly from every setback, and remembering his ultimate observation. The market does not beat them. They beat themselves because though they have brains, they cannot sit tight.
They can't sit tight. Patience and discipline again.
It often comes back to self-mastery being the most critical skill in this game.
Well, we really hope this deep dive into Jesse Livermore's timeless, sometimes brutal wisdom has given you some profound aha moments. Maybe a fresh perspective on what it takes to truly understand the markets and maybe even more importantly, understand yourself.
It's a journey into market psychology that feels as urgent today as it did over 100 years ago.
Absolutely. Until next time, keep digging, keep learning, and keep trusting your own deep dives.